Stocks start sharply lower but recover a large part of the losses with advances sharply outpacing losers. Autos and industrials lead the recovery while energy, metals and IT trade weak.
All right, auto companies report a mixed bag so far in August. Ashok Leyland reports a 51% jump in sales and tractor maker Escort ekes out a healthy 7.3% year-on-year growth. Bajaj Auto, though, reports a steep fall in exports due to the Nigerian market under pressure.
Reports suggest that the Competition Commission of India is concerned about the competitive implications of the Zee-Sony deal. Zee counters it, saying its market share is down and the CCI queries are procedural.
And the Q1 GDP comes in below expectations at 13.5%. Services and manufacturing disappoints. Brokerages like Citi and Kotak cut their full-year GDP forecast to 6.7 to 6.8%.
Hello and welcome. You're watching us here on Halftime Report. It's halfway through the trading session and it looks like a lot has happened in that first half of trade. We started well. We started weak, then we saw a bit of a recovery, and that recovery is getting sold into. So it'll be interesting to see where it goes. I'm Manglam Malu. With me is Sonia Shinoy. Sonia, we did well, saw that recovery, and maybe now things are getting jittery because the one thing that stands out is the way volatility has increased. The India VIX is up, what, 11.5% as we speak?
It is. But, I still believe that this is a market where the dips will be bought because we do have, the lows was around 17,485. I agree that now it's getting a bit volatile. But if you look at individual stocks, right, even from the frontliners, there are plenty of stocks that are still well in the green and are bucking the market trend, whether it's the NBFCs. Bajaj Finserv has been the biggest gainer. A lot of the domestic-facing consumption stocks, so whether it's Tata Consumers, Asian Paints, you have Eicher Motors, Titan, Hero Motocorp, M&M, this whole lot. Of course, autos have done very well. In fact, on that note, let's talk about steel strip wheels, because this is one company that has reported a very strong 15% growth in monthly sales. In August, the alloy wheel sales have gone up 100% year-on-year, while the truck segment has seen an 80% rise. Even in the quarter gone by, Q1, the revenues went up almost 50% and the EBITDA was up about 15% or 12% rather. So looking good there. Mohan Joshi, who heads the corporate strategy and investments at Steel Strip Wheels, joins us now to talk about that. Mr. Joshi, good morning and thanks a lot for joining in. If you can start by telling us about the month of August, because the sales went up by 15%. You've seen very good traction across the board actually, with trucks and alloy wheels doing the best. But where do you see big demand coming from for the rest of the year, and what could the average growth be?
Very good morning and thanks for having me. For the month of August, we did close to 15% on the top line. In the primary demand, which is getting driven by the PV side, which is very, very strong, backed by the backlogs of orders of all these car makers in the country. I think the month is a little subdued than our expectation on account of very heavy rainfalls in parts of the country where CV contributed a little less. And we feel that this is what is going to be the most pivotal part for the balance of the year, that with festive season coming on, CV will start contributing towards the balance 6 months. For the full year, we feel that all the segments, be it PV, they will contribute maybe growth of plus. CV will contribute close to 20 to 22% kind of a growth. Tractors will contribute close to 7 to 8% kind of growth. On alloy side, as I said, it's the strongest vertical of our business, which is running at full capacities and is expected to run down at a pace of 45 to 50% growth. And what I feel is that for the full year, for the organization, we feel we are going to be growing at between 15 to 18% on the top line. And the SAR point is still the exports, where some bottoming out is happening because of these geopolitical issues. And we feel that the worst is over and behind us, and slowly and gradually going into the H2, you will see green shoots coming in from the export side also.
Right. I'm just looking at a couple of numbers. You said that you are looking at 15 to 18% growth overall. At 18%, you would do roughly 40 to 50 crores in terms of a top line this year. Is that correct?
Yeah.
But
yes,
that would mean a decline from your earlier guided band of anywhere between 4,800 to 5,000 odd crores, because earlier, the last conversation that we had, you had guided for revenues, domestic revenues, between 41 and 4,200 crores, whereas exports, you said would decline from over 800 crores to about 600 crores. What's your sense? What will lead this, cut in the guidance, so to say, and how much will you end up in this year as far as exports are concerned?
So just to clarify that guidance, the earlier last year turnover was close to 3,500 crores, which was anticipated at between 4,500 to 4,200 crores, in which the exports are 600 crores. So it was 3,500 plus 600 crores, which was at 4,100 crores guided last time, which is now at 4,200, 4,250 crores that we anticipate.
Okay.
And exports, what's your guidance from this year? How much will you do?
See, we feel that around about 600 odd crores will be the exports for the financial year 22-23.
You had also told us that your EBITDA, FY23 EBITDA is targeted at 450 crores. But this is actually less than what you did in FY22. FY22 was about 466 crores. Is it because of the margin pressures? Now actually raw material prices have cooled off. So would you want to change that guidance on the EBITDA front?
I think for the full year, we guided that it is going to be between 500 crores plus minus 5%. And we feel that between 475 to 480 crores is what the anticipated EBITDA for the financial year.
So, Mohan,
so the previous year, we had the margin of 466 crores worth of EBITDA. So on an annualized basis of these one-offs to be taken out, I think EBITDA will accrue and grow at close to 20%.
Okay, so 20% growth on the EBITDA front is what you're expecting in FY23. The reason I ask is because you're also supplying to a lot of the fast-selling new age products, right? Whether it's the Tata Nexon in the EV space or the Tata Harrier. You have companies like M&M that you supply to that are having, exceptional sales this month around. So I just wanted to know from you, have your margins, your blended margins, will they go up? Has the kit value gone up for a company like yours? And can you sort of sell, to these higher margin products or to these higher margin cars and hence improve your operational performance by the end of FY23?
So what I feel is that if you compare it over past 2 years, we are at the highest EBITDA per wheel kind of a matrix right now for the company. And that is also going back to the history that it has never been done that way. And the anticipation for this financial year is that on a operational matrix in terms of absolute EBITDA per wheel, we should be improving on the last year's financial performance.
So what is the EBITDA per wheel currently?
Can you please repeat that?
What is, you said it's the highest EBITDA per wheel in the last 2 years. What does it stand at currently?
I think it's a little sensitive subject. Okay. So as you say that, we did close to 11% in terms of absolute EBITDA last year. For this financial year, I think we should be adding up close to a 10% improvement on this. And the absolute EBITDA that we are trying to target over, short term to medium term is between 12.5 to 30.
Okay, we take that point. Can you give us a sense of the alloy business itself? You are saying that it will be around 45 to 50% growth that we see. What is the contribution of that? And because the plant's running at full capacity, are you looking to add some further capex there?
So as the plants are running already at full capacity, there is a capex which is going to be done over next 7 to 8 months to add close to 1 million capacity. With the order flow which is visible to us over next 12 months, as soon as this capacity will come, close to 60% will also be sold out. So inorganic as well as organic opportunities are being eyed by the organization, and because it's a future in terms of the business, and it has a lot of growth potential on exports. So obviously the organization will continue to look into the opportunities for growing capacity.
Mohan, if you could give us some more details on that. Mohan, how much does it contribute right now to your overall revenue, alloy wheels? What is the current capacity? And, what is the margin differential between alloy and the other parts of your business?
Okay. So on the last year's benchmark of 3,500 odd crores, we did close to 700 crores coming in from the alloy side. Steel versus alloy, there's an absolute margin difference of close to 500 basis point, which is where the alloy is at a 500 basis point higher than the steel. And that's why these EBITDA accretive business is a core where domestic as well as export markets are being eyed. I think we have done fair bit of success in steel wheels by penetrating global overseas markets. The similar kind of trend will be seen over the next 2 to 5 years for exploring these markets for alloy wheels also, because customers are the same. and they have steel as well as aluminum demand. And that's where the focus is.
Okay, for many years, you've been known as the steel wheels, alloy wheels company, right? But I understand that you're also looking to get into the sale of new products like motors as well. Tell us a little bit about that. I think the last time you said that that's a potential 1,000 crore revenue business. By when do you think you can start, and what are the other, what is the expansion that you're planning?
I think the core capex in that, is not going to be very large. Because it's a kind of an opportunity that we are looking for futuristic growth into the EV space, because wheel is getting made by us. So if motors can be accumulated, that customer benefits the most. And because China is a dominant supplier to India currently, and we feel that India has all the capabilities to get into this business and move forward. So we are sticking the benchmark right now, and we feel that over the next 2 to 3 years, this is a great opportunity to win this business if you believe in EVs, especially on the two-wheelers.
Right.
Industry has the potential of a top-line creation of close to 1,000 crores. Currently, we are in talks with many agencies, and obviously the talks are premature. Over the next 6 months, these premature talks will mature, and we'll keep the street updated on this.
Right. I remember you had said that you will announce a JV or a tie-up in the next couple of months. So we'll await further clarification on that. Final question, promoter pledge is at around 17%. Where do you see that go? It has reduced considerably over the last 12 months or so. And secondly, Tata Steel still holds about 7% stake in your company. Will they continue to hold? Any conversation from them to maybe, sell that stake off?
So Tata Steel is a strategic investor and probably 70% of the supply to us in terms of the input steel, and I think that relationship goes much beyond the stake, and they hold a critical engineering importance for us also. So there is no talks of any dilution of their stake. That is one. The second thing is that pledge was reduced from 52% to currently at 17.5%. I think for the full year that we are trying to guide is that this should be brought below 5% by this financial year end.
Okay, all right. We will leave it at that. All the best, and thanks a lot for joining in. That steel strip wheels reported a very healthy growth in the month of August, and they expect that trend to continue. A quick reminder for our viewers, it's that time of the year again. Money Control Pro's Financial Freedom offer is back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or the website.
आग को फैलने से रोकना मुश्किल है, पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाइड क्लब प्राइम आग से बचाए।
ये जमीन तो स्वर्गीय पिता के नाम है ना?
हाँ सर।
माँ का नसीब भूल गए?
नहीं भूले सर।
और तहसीलदार का?
और एसडीएम सर का भी। और कुछ सर? भाई जी, एक लास्ट साइन रह गया है आपका। कंग्रेचुलेशंस, आपका कृषि लोन अप्रूव्ड।
थैंक यू। हर बंद राह ओपन हो सकती है, लगता है सिर्फ दिल। एक्सिस बैंक, दिल से ओपन।
Welcome back. Let's now shift focus to some macro cues. The first quarter GDP data has come in at 13.5%, which is below market expectations of around 15%. The GVA2 has come in at 12.7%, which is below the CNBC-TV18 poll. Lata is here with what was disappointing this time and what was not so disappointing. Lata, over to you.
Well, first the numbers, GDP first quarter number came in at 13.5%. The CNBC-TV18 poll, or the street estimate, was between 15 and 15.5%, and the Reserve Bank's projection was 16.2, so it's lower than all that. Now, if you adjust this number to the Reserve Bank's projections, then the Reserve Bank's full year forecast falls from 7.2% arithmetically to 6.7%. Now, let me just explain why this 13.5 is a bad number. At the outset, 13.5 GDP growth, over 20% last year, looks good. I'll tell you why it's weak. if you take the actual Q1 GDP, it is 36.85 lakh crore. And this is only 3.8% higher than 3 years ago GDP of FY20. That's a poor record of growth. The weak elements are first construction. Construction GDP has come in at 2.62 lakh crore. That's the latest quarter, which is a good 16.8% higher than last year, but it is only 1% higher than the 3-year-ago level. That is the decline in consumption. Likewise, another huge category, trade, hotels, transport and communication. It's a large segment. Now, there the GDP is 5.59 lakh crore in the latest quarter, a good 26% higher than last year, but 15% lower than what it was 3 years ago. And both these sectors are, large employers. They comprise, the small Udupi hotels, traders, medium and small enterprises, unorganized labor in construction. Now, that is the weak part. What are the strong points of the GDP? Private consumption. Private final consumption expenditure has come in at 22 lakh crore, which is 26% higher than last year. And over the 3-year level, it's a decent 10% higher, which is over a 3% compounded growth. Likewise, capital formation. Capital formation has come in at 12.8 lakh crore, which is 20% higher than last year, but a decent 6.7% higher than the 3-year-ago level. Not spectacular, but at least it's not bad. Now, following the weaker than expected Q1 headline number, many brokerages have cut their full-year estimates, mostly to around 7 or below 7. Citi is the most important. They have cut their real GDP number to 6.7. They were standing at 8, so that's a huge cut. JP Morgan has merely said that they are standing at around 7%. So it's not above 7. Morgan Stanley has cut it from 7.6, where they were, to 7.2, so a 40 basis point cut. And CLSA was sitting at 6.7. They have upped it to 6.8%. But the short point is there is a very good possibility India will not get to 7% growth this year. It may be a 6 handle, maybe 6.8, 6.9.
All right, Lata, take your point. Thank you so much for that. In fact, the government has defended the Q1 GDP numbers, saying that it is consistent with the 7.5% growth estimated for FY23. It rules out adjustments in FY23 borrowing target and says that India needs to grow about 5% in the coming quarters to achieve 7.2 to 7.4% growth. Sapna joins in with more on that. Sapna.
Well, the government definitely has come out in strong defense of the Q1 GDP numbers, 13.5% versus the RBI estimate of 16.2%. They are very clear on the fact that this 13.5% is very much consistent with the overall growth estimation of around 7 to 7.5% for the current financial year, or even 7.2 to 7.4%. That's one. The reason that they're mentioning is that, number one, of course, in the remaining quarters, India may have to grow just at around 5% to achieve the overall growth handle of the 7% range. That's one. Second, government capex has been doing very well. 2.1 lakh crore worth of government capex between April, July. This is 62% higher Y-on-Y, and also this is a major chunk of the overall 7 lakh odd crore number that they've set out for this year. If you also look at the high frequency indicators as per government data, that's showing a big uptick. So overall, they are, they're pretty confident that the 7 to 7.5% growth range for the current financial year is very much doable. Last but not the least, they are also not expecting any major change in the borrowing target, and they are also pretty confident about achieving the fiscal deficit aim in the current financial year.
Okay, Sapna, thanks a lot for that. But getting back to the markets now, Z Entertainment is on our radar. The company has signed a licensing deal with Disney Star for the men's cricket events. Meanwhile, Z's stock is under pressure, though, amidst CCI concerns over its proposed merger with Sony. Mangalam, there's a lot happening here.
There's a lot happening here. Let's simplify it into two things. One is ICC, the other one is CCI. And currently what's happening is the CCI, which is weighing down on the stock, which is down, it's about 4%. But the good part is that the fact that the company's gone ahead and signed a licensing agreement with Disney Star to broadcast ICC tournaments between 2024 and 2027. And what does that mean? That, gives them access to air all the ICC tournaments, which is two T20 World Cups, one Champions Trophy, and the 2027 ODI World Cup on their linear TV channels. The deal financials have not been disclosed, but analysts believe that, the payments would be staggered, so that would have a big impact on their earnings. But what it'll do is it will increase their linear TV viewership, as the company was lacking any significant presence in sports. So as a result of which, this could be a benefit for them, but that will be only 2024 to 2027. The current concern is that there was a report which suggested that the initial review of the Competition Commission for Zee and Sony's merger has found some concerns. Analysts say that the information exchange with the CCI is usually not unusual, and these are just initial findings. So let's see how that comes by. On the company's part, they said that the numbers mentioned in the story have been taken from FY21, and the updated numbers, actually FY23, indicate that the combined share of both Zee and Sony would be about 36%. In any case, they will be in constant dialogue with the Competition Commission itself. So what the outcome of this is will cause a bit of an overhang, and that explains why the stock is under pressure despite no seeming immediate worry on the merger front.
Okay, well, that's on Zee Entertainment, but let's go across to Rima now. Biocon is the one that's under quite a bit of pressure after the US drug regulator has issued a slew of observations for its 3 biologics units. Rima is here to tell us more. Rima, over to you.
Thanks so much for that. So, well, the stock is under pressure because US FDA has issued 11 observations each for its 2 sites in Bengaluru and 6 observations for its site in Malaysia. These, the US FDA inspections took place in the month of August between 11th to the 30th. Now, we had a chat with the management earlier today, and they said that there were no systemic, no compliance issues which were cited post the US FDA inspection. There were no data integrity breaches as well, which were observed by the US FDA. The inspection was done for 3 different products also. So that was the reason why the US FDA came to the sites in the first place. The company will respond to the US FDA within the next 15 days. And as of now, they do not expect any impact on the company's product pipeline in terms of the approvals as well. So the company said no changes in the approval timeline in our chat with them earlier. Back to you.
Okay, Rima, thanks a lot for that. In fact, we had a chance to catch up with Shreyas Tambe, the head of the Biocon Biologics segment. Listen in to what he had to say.
There are no systemic non-compliances that have been cited in any of these observations that the agency has put out. And there are no data integrity breaches that you specifically talked about. Since we didn't have inspections since 2009, we have been waiting for the agency to get over to our facilities. This inspection was at 7 different manufacturing facilities at 2 different locations, Bangalore and Malaysia, for 3 new products. Post the inspection, we have no reason to believe that there is any change to that timeline. The inspectors didn't indicate any change to that approval timeline. We would be looking to consummate that and close the transaction by the end of the first half of this fiscal, first half of H1, as we said. And we are on track for that. We look to close that end of September.
All right, we're just a month away from ending Q2, but Spicejet has reported their Q4 numbers, and Sonia, they don't look good. 500 crore loss.
Oh, you know, it's the troubled aviation company Spicejet has been under pressure for a very long time now, and the company has reported steep losses both in the March quarter and in the June quarter, which they reported after a big delay. So the losses have been piling up for Spicejet. It's not looking good. As per the financial statement, there's a net loss of almost 500 crores as far as Q4 is concerned, and this compares to just a 250 crore loss that they saw same time last year. But more importantly, for the full year FY22, it's a staggering loss of 1,721 crores compared to a loss of sub-1,000 crores last year. In Q1 as well, the numbers are not looking good. There's a net loss of 784 crores. Now, the company says that there's a big surge in ATF prices, and that has hit their bottom line quite a bit. ATF prices are up 105% on a year-on-year basis and up 40% on a sequential basis. The management, Ajay Singh, does mention in the press release that this is the most severe operating environment in the recent past. And you know what, there are problems galore, right? Not only have losses piled up for Spicejet, the company, if you remember, recently delayed salaries for the 2nd straight month in the month of August. The Chief Financial Officer, Sanjeev Taneja, resigned on the 31st of August as well. And auditors have said that these results have cast significant doubts about the company's ability to continue as a going concern. So there is an accumulated loss of over 5,900 crores as of March 2022. And this has caused the current liabilities to exceed the current assets by over 6,400 crores. So it's troubled times for the aviation company.
Troubled times indeed. We've seen that in the way the stock has corrected from the highs as well. Down 5% today, but from the higher levels, it has corrected a lot more. But as we speak, we do have a lot of stocks which are surging. TCPL packaging from the broader markets up almost 7%. We have Marathon Next Gen, which is another 8% gainer right now. And from the F&O space, LIC Housing Finance along with Indian Hotels are a couple of buzzers. LIC Housing Finance, our ticker team, also alerting us. And we have Indian Hotels, which has hit a fresh record high. This morning we had Ajay Srivastav saying that, hotels are likely to do the profits that they've never seen in the life of their existence so far. And that's how strong the sentiment is in this hospitality space. We've seen that in the stock price move. Let's see whether numbers come by or not. Take a short break, come back. We get in Ruchit Jain with some trading strategies on the other side. All right, good time to get in Ruchit Jain to give us some technical views on the market. As we speak, we are seeing some bit of a sell-off from the highs, but holding around with a cut of 150 points on the Nifty, around that 17,600 mark, comfortably above that 20-day moving average of 17,580. Ruchit, your thoughts on what happens from here? Because it's been a little more volatile today than it has been in the past, where, dips were cleanly bought here. Maybe some bit of a concern at higher levels?
Yes, hi, very good afternoon, Mangalam. Well, yes, I believe that if you look at indices, post that high of 18,000, the momentum readings on the daily charts went into a sell mode, due to which we got that price-wise correction from 18,000 to 17,300. But since then, we have seen a pullback move as well. But it seems that the market is still trading in that corrective phase, and we have not yet resumed the high degree uptrend which we saw before 18,000. And usually corrections are of two types, either a price-wise correction or a time-wise correction. So this time the market is undergoing a time-wise correction rather than showing any price-wise correction on the index. So I believe that market would not be in a hurry to cross that 18,000 or 17,800 levels quite soon. On the index front, you would not witness any big up moves from here on. 17,800 would continue to remain on the resistance, and the lower side 17,500, 17,400 would be the support. So we are of the view that the index would broadly trade within this range, and upside would be limited due to this. So this could be taken as a more of a time-wise correction, and within this time-wise correction, the stocks are doing well. So the market breadth is positive. Some sectors have even broken that previous week's highs. So traders should approach more of a stock-specific strategies now here on rather than going with the index.
Okay, and what would those stock-specific strategies be?
Good afternoon, Sonia. I have two buy recommendations, considering that the market breadth is good. So first is a buy call in Tata Consumer. Clearly, this has been one of the relative outperformer recently as well. And technically, there was an ascending triangle pattern which has been formed, and the stock is on the verge of breakout from that. Even volumes-wise, the volume action is also quite good. So one can go long at Tata Consumer at current levels with a stop below 805, expecting target somewhere around 865. And real estate pack has been doing quite well. This index has not even crossed its previous swing highs, but also stocks have witnessed quite good volume, so outperformance is likely to continue. Prestige Estate, one of the mid-cap names within this realty space, has given a breakout today, supported by very high volumes. So the previous highs has also been taken out. So we are expecting a good up move in this stock. Currently at around 483, one can go long with stop loss below 462 for potential targets around 515 to 520.
All right, Ruchit, thank you for that. But in a market like this, the one thing that is an outperformer today is the rupee. It's risen a little, 0.1 over a gain that we saw on Tuesday as well. The rupee is now back at mid-August levels of what, 79.3 per dollar. Lata, your thoughts?
Well, actually, the stock market is not the only place where we have decoupled. What I wanted to say is that both in the currency and in the bond markets as well, India is an outperformer. The currency, rupees rallying despite all Asian EMs lower today, primarily because the dollar index is once again back at that 109 mark. This is, of course, there were strong FPI portfolio flows on Tuesday, and probably a residual amount is flowing into the market today as well. Lower crude is clearly a pro-rupee sentiment, and that'll make a rupee shorts cover. But more than that is this RBI's strong defense of the $80 mark, which is also making exporters nervous and bringing them into the market. Every time it goes towards 70 and 80 or thereabouts, people are coming in to sell, believing that they may not get higher levels thereafter. The bond rally is also very important. The 10-year yield fell to as low as 7.16 at a point in time. And remember, just last week, they were trading at 7.3%. So that's quite a rally that you're seeing. This is, of course, strong short covering in bonds because of the lower crude price, now at $94 Brent. Last week it was, 105. But more importantly, this chatter of bond inclusion is catching on, and there is an expectation that some months down the line there could be big buyers in bonds. There is also a chatter of HDFC having raised 10-year money locally. Normally when it does this, HDFC swaps it in the OIS market for a floating rate. They sell fixed and they take floating. And those people who sell the fixed to them come and buy bonds to hedge their exposures. I mean, it's a little complicated, but the long and the short of that is that there is bond buying even on for those reasons. And therefore, a goodish bit of decoupling of the Indian currency and bond market from global markets.
Okay, thanks a lot for that. Perhaps that's what's happening in the equity markets as well, right? Decoupling compared to its global peers, holding up amidst a challenging global space. But on to a CNBC-TV18 exclusive. Sources tell us that the IRDAI is likely to look at opening up distribution architecture further. Yash is here with more details on that. Yash.
Well, that's correct, Sonia. So the insurance regulator now is looking at, opening up the distribution architecture further. Very recently, IRDAI has floated a draft consultation paper which essentially allows banks to tie up with 9 life, 9 general and 9 standalone health insurance companies as compared to 3 earlier, which means that these banks will be able to sell products from 9 life, 9 general and 9 standalone health insurance companies. The latest that we've been given to understand is that the insurance regulator is looking to do the same thing with individual agents as well. As of now, individual agents can only tie up with 1 life, general and standalone health insurance company. The thought with the insurance regulator is to open it up and allow these individual agents to tie up with 3 of each category companies, which is life, general and standalone health. Now, this will essentially, the purpose for doing this is so that agents can sell products from more insurance companies. There's more competitiveness in the market, and also at the end of it, policyholders have more options who buy these policies from insurance agents. But as far as companies are concerned, this will be particularly negative for the Life Insurance Corporation of India, and that is simply because of its large agent strength. LIC has about 13.3 lakh agents in the market, which is essentially about 50% of the total agent strength in the industry itself. There, 55% of the total individual premium come through, the policies which are sold by agents. And if individual agents are allowed to tie up with more insurance companies, then there is a high possibility that a private player might pay higher commission to insurance agents and really poach them in that sense, affecting the main pillar of strength for a company like Life Insurance Corporation of India.
Take that point, Yash, and a lot of people have, made their living selling life insurance products from LIC. Let's see what happens to them, and more importantly, what happens to the business of LIC, which is based on all these individual agents, so to say, as far as selling their policies are concerned. We take a short break, come back, we connect with the management of Shriram Transport to decode demand on the other side of the short break.
That's the boss's cabin. The canteen is behind.
Good morning, ma'am.
Good morning. And you are here. Good morning. Good morning.
मैम और कोई ऑप्शंस?
लाइफ में और कहीं ऑप्शंस मिले ना मिले, मोतीलाल ओसवाल आपको देता है ऑप्शंस ट्रेडिंग में ऑप्शंस। इंट्रोड्यूसिंग मोतीलाल ओसवाल ऑप्शन स्टोर विद अ वाइड रेंज ऑफ ऑप्शंस इन ऑप्शंस ट्रेडिंग। एक्सप्लोर करो ऑप्शन स्टोर ऑन एमओ इन्वेस्टर एंड एमओ ट्रेडर ऐप। डाउनलोड नाउ। इन्वेस्टमेंट इन सिक्योरिटीज मार्केट इज सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल द रिलेटेड डॉक्यूमेंट्स केयरफुली बिफोर इन्वेस्टिंग।
मैडम जी, वो सारे पैसे लेके भाग गए और मेरा वड़ा पाव भी ले गए।
दिखाते हैं इनको।
वोटर वड़ा पाव?
हिलर, निकाल दे इसके बाद। पंक्चर के बाद भी इससे हवा नहीं निकलेगी, क्योंकि ये है जेके पंक्चर गार्ड टायर, जो कील लगने के बाद भी होता है हील। जेके पंक्चर गार्ड टायर, अब हवा नहीं निकलेगी।
हिंदी, उर्दू, पंजाबी, भोजपुरी, मैथ। जीनियस। अच्छा, शहर कौन सा?
सही सवाल, गलत जगह। सही जगह है ग्लोब कैपिटल, जहां पर आपको मिलेंगे अवार्ड विनिंग रिसर्च बेस्ड आइडियाज, अपने पोर्टफोलियो को मैनेज करने की सुविधा। ग्लोब कैपिटल, मनी मस्ट ग्रो। इन्वेस्टमेंट इन सिक्योरिटीज मार्केट आर सब्जेक्ट टू मार्केट रिस्क। Read all the related documents carefully before investing.
Okay, welcome back. Well, for now, the market is not too bad actually. It's still down about 150 odd points, but holding around that 17,600 level. The mid-caps have recovered in a big way, so don't lose sight of that. In terms of, big stocks that are moving up, a lot of the consumption stocks, even in the mid-cap arena, are looking pretty good. So you have some double-digit moves. Look at Dish TV, it's up 20% right now. You have something like Ashok Leyland, of course, that's up almost about 4%. Zomato is up about 4%. And a couple of other names like Bank of Baroda, SBI, etc. doing pretty well. But let's talk about the financiers now. Umesh Revankar, the Vice Chairman and Managing Director of Shriram Transport Finance, joins in. He's going to tell us a little bit about demand and the business outlook as well. Mr. Revankar, good afternoon and thanks for joining in. This whole commercial vehicle space has picked up in a big way. Yesterday, Ashok Leyland was telling us that not just infrastructure activity, but now there's big demand coming from e-commerce and logistics as well. Can you tell us how much of your business comes from the MHCVs, how much from LCVs, and also, what is the kind of pickup that you are expecting in disbursements because of this demand push?
Yeah, thank you. See, the overall demand from MHCV is predominantly coming from the infrastructure development, because wherever the application is for the infrastructure, the demand is very high. Especially the dumpers are categorized as a commercial vehicle. So normally the sales are coming from a dumper. And even some large vehicles, the demand has gone up, especially the 14-wheel category. Now there are some new launches, demand is coming. But the e-commerce demand is something is consistent. It is there for last 15 months. And consistently we are seeing the demand is coming up for new vehicles plus the existing replacement both. The new demand is coming added to the replacement. So I feel the growth in the e-commerce and the local last mile distribution will be much higher and consistent.
So when you say higher and consistent, can you give us some numbers? Now that, I'm just going through a report that JP Morgan has put out where they say that after a 4-year hiatus, disbursements are picking up across the board. And, a lot of auto financiers on an average have grown about 7% over the past 3 years. But in the heydays of that FY11 to FY19, the compounded growth was almost 17%. What do you think the compounded growth rate could be for your industry and for your own company over the next couple of years?
My sense is that 15% CAGR growth is something which we should expect for next 3 years in both heavy and all category put together, because there could be some mismatch in our growth, because most of our growth statement would be on the disbursement amount, and the way the actual sales happens in units, number of vehicles. The vehicle prices have gone up significantly for the larger vehicle. Especially the popular vehicle 14-wheel today costs somewhere around 47 to 48 lakhs fully finished on road, which was around 34-35 lakhs maybe 2 years back, 2 or 3 years back. So BS6, input cost, steel price, all have increased the price. And one of the reasons for delay in demand for the heavy commercial vehicle is the steep increase in price. That unless the economy is able to absorb it, it will not get immediately absorbed by the buyers. So heavy commercial vehicle will take some time to get absorbed and put into use. In lighter commercial vehicle, it gets absorbed fast because of increased e-commerce activity and also requirement of a last mile reach. So I feel the growth rate of the NBFCs, which is in the volume terms of disbursement amount terms versus the industry unit sales, there will be some differences for some time. But I think on average, 15% growth is something which we are expecting. In our company, we are looking at around 12% growth on the commercial vehicle side.
All right, 12% growth on the commercial vehicle side. You know, you spoke about disbursals and your optimism emanated from the strong disbursals that you have right now. 30% is what your disbursals grew at in the first quarter, but that somehow did not translate into AUM growth. The AUM growth was just about 9.5%, under 10%. Can you explain why exactly that happened? And, you know, to that extent, what is the kind of overall growth that you're looking at this year?
See, comparing with the last year, same quarter, the first quarter will be a challenge because that was where the COVID wave 2 had hit. But otherwise, we are expecting a 12% growth for the company as standalone on the commercial vehicle side because, we are focused on the used vehicle and the rural application. So application for which we are lending is little different from the heavy vehicle. Heavy and construction vehicle, we don't really lend on a new vehicle in a big way. So the volume growth or AUM growth will not come to us that much as the other competitor or other NBFC will get. So we are looking at unit growth, and we have targeted 12%, and we are confident of reaching that.
Okay, you said there could be a 15% growth overall in disbursals of CV financiers. Now you cater to both the segments, which is pre-owned commercial vehicles and new commercial vehicles. Can you just break it up for us? Where are you seeing the maximum amount of demand? Are fresh CVs, you know, is that demand going up there?
We have a breakup of 10% in new vehicle and 90% in used vehicle because we are focused on individual customers. We don't focus on fleet operators. So the new vehicle are typically purchased by fleet operator, and individuals are typically buy used vehicle, and sometimes they upgrade to new vehicle. So the customer whom we lend for a new vehicles are typically who are upgrading from the existing used vehicle to the new vehicle. And sometimes in the last mile connectivity, people do buy new vehicles. So our focus area is totally different from what the market is.
Right. Mr. Revankar, you know, let's move away from CVs for a bit and let's talk about the other parts of your business. The first one is, what are you expecting in terms of asset quality and performance for your non-CV business? And the second part, what's the timeline on the merger of Shriram and Shriram City Union Finance?
The asset quality by and large is good and improving because the segment which we are lending, say a commercial vehicle or the middle income group, business group which we are lending, both of them are having good businesses, and the environment is quite positive even in the rural area. So we are witnessing improvement in the asset quality Q on Q, and I feel it will be sustainable. And I think we should be able to, in a standalone Shriram Transport, we should be able to maintain the net NPA, which is at around 3.5, around that. But the asset, the credit loss, we expect it to come down from around 2.5 level to around 2% by the end of this financial year. As far as the merger is concerned, the final NCLT of the meeting is on 22nd September. So we expect everything should, because all other approvals have come, we expect it by the September end or maybe first week of October order. Then we need to go to ROC and all other requirements are there. So by the end of October, we should be fully ready. And even otherwise, internally, we are working for the merged entity continuously now, and we are fully ready to function as a merged entity by the first week of October.
Okay, all right. Mr. Revankar, we'll leave it at that. Thanks a lot for joining us and all the best. That's Shriram Transport Finance. Let's slip into a quick break. On the other side, we'll put focus on the auto sales for the month of August and give you a quick snapshot on how things look this month around. Stay tuned.
who are always looking for what's next. Changing lanes, shifting modes, always in command. Sensing what lies ahead. The all-new Hyundai Tucson next drives now.
LIC आत्मनिर्भर भारत की गौरवशाली संस्था मना रही है आज अपना स्थापना दिवस। गत 66 वर्षों से मिल रहे आपके प्यार और विश्वास के लिए हम आपका हृदय से करते हैं धन्यवाद। सुरक्षा और वचनबद्धता का ये सफर हमेशा रहेगा बरकरार। LIC हर पल आपके साथ।
Well, it's the first of the month, so we also track auto sales, and they've been trickling in so far, and they don't look bad. In fact, they look good with good commentary coming in from the managements as well. So to give us a roundup of all of that, we do have Sonia with us. Sonia, take it away.
It's a good set of numbers that's coming in from the domestic space because domestic demand is picked up in a big way. Let's start with Bajaj Auto, and I'll tell you why. Bajaj Auto reported very strong growth in the domestic sales, but exports have been under a lot of pressure. So overall sales are up by about 8% year on year, but export sales are down 28%, and the management told us that that's because of a huge slide in retail sales in Nigeria. Now, Nigeria is restricting two-wheeler sales, and that's due to that, the retails have shrunk 25 to 30%. Remember, Bajaj Auto gets about 20% of its export revenues from the Nigerian market itself. However, domestic sales are quite strong and they expect a minor growth in the festive season as well. Escorts is at a fresh 52-week high this afternoon on the back of very good numbers coming through. A 7.3% year-on-year growth is what we've seen for Escorts this time. Domestic sales are up by almost 8%, while exports are up by 4%. But more importantly, it's the commentary from the management which has been good. They've guided for a better September, saying that there's most likely a stretched peak selling season of 3 months, and overall the macroeconomic factors and the farmer sentiment remains positive. Ashok Leyland is the other one. They just reported numbers a while back and very strong growth across most segments. Total sales up 51%. The medium and heavy commercial vehicle segment has gone up 81% year on year, and light commercial vehicle segment is up 21%. And in that context, they've won a fresh order from UAE for the bus segment. This is the largest ever bus order from the United Arab Emirates. This is for 1,400 school buses, and the total fleet deal is worth over $75 million. So most companies have reported very good sales in the domestic market.
All right. So there's rock music playing in Motown, so to say. The other stock that we have on our radar today is Dish TV. Now, we don't talk about this very often because lately it's been falling out of favor with investors. But today it's locked in upper circuit, just a 14 rupee stock. Why exactly is that? Vahishta joins in with details on that. Vahishta.
Hi, thanks for that, Mangalam. Well, yes, Dish TV has been in focus today, and this is because the chairman and non-executive director, which is Jawahar Lal Goel, has stepped down from the company. The shareholders of Dish TV had rejected the proposal to reappoint him on the board, and Yes Bank, which is Dish TV's largest shareholder with nearly 25% stake, had opposed Mr. Goel's reappointment. This is also because, additionally, we also know that Yes Bank had sought the removal of 5 directors, including Mr. Goel, citing corporate governance issues in the past. That's why the stock has been in focus today. Back to you.
Okay, thanks a lot for that. Well, in our special segment Value Plus, we are tracking Emami. Earlier today, we spoke to the management on their business outlook. Mangalam, what's the key takeaway there?
Well, a couple of key takeaways, and that explains why the stock is doing well in today's trading session, is up at the high point of trade. As far as the business is concerned, they said 3 things. The second quarter demand is not as strong as expected, but they expect strong recovery in the second half, primarily because monsoon harvest will be good, and at the same time festive demand is expected to be strong as well. Dermicool, which when they acquired was a 110 crore brand, this quarter did sales of almost 62 odd crores. They said the next year could be a brand worth almost 140 to 150 odd crores. So that would be the other leg of growth on the company. For this year itself, they expect around 11 to 12% revenue growth with 28% margins. Emami has the highest margins in the industry itself. So they believe it will hover between the 28 to 30% mark. But importantly, they're investing in distribution. And going forward, maybe next year, they will do about 13 to 14% in terms of revenue growth. The other aspect that we watch out for Emami is the promoter debt and the pledge on the promoter's stake that the company, the stake that the promoters hold in the company. 37% is where it stands at. And to that, they've said that they will reduce that by about 7 to 8% once the family-owned hospital AMRI, the deal is done. Remember, it's been on the block for a very long time, but here on CNBC-TV18, the management confirmed that it will conclude in the next 1 to 1.5 months for which they will get about 1,500 odd crores. So, the deal is done, is a foregone conclusion, is what we got from what the management has said. The stock has been an underperformer. From its 52-week high, it's corrected about 20%. In the last 12 months, it's down 18% as against the FMCG index, which is up 10%. And in light of that, it trades at around 24 times. So not particularly expensive either. So let's see if things turn around for the company.
Okay, let's see if things turn around. But for now, the stock has been an underperformer. Let's listen in fact, to excerpts of the conversation that we had with the management.
We haven't seen the kind of recovery we expected in this quarter, though the monsoons barring east have been good across India. But unfortunately, we haven't seen the rural recovery as of now. But we are extremely hopeful that maybe H2 should be a better year than what is in quarter 2. So we are definitely targeting about 11 to 12% growth as far as the H2 is concerned. Though it is not the season for Dharmikul, the season would now start from February. We are very confident that we should get to about 140 to 150 crores.
Okay, well, those are Eicher Motors numbers as well coming up for you on the screen. These are the commercial vehicle sales that Eicher Motors has reported. It's a 4.5% growth, not as good as some of its peers, but nevertheless, it's a growth that they've seen in their commercial vehicle basket. I'll try and get more details, but in the meantime, let's take a quick break. We'll come back with lots more on the market. Stay tuned.
But we've been talking about the way the Nifty Bank has come back in terms of an up move in just the last few months itself, has been the leading sector. Now we've got some upgrades as well. Credit Suisse has upgraded its earnings forecast for a bunch of large banks on the strength of higher margins and lower credit costs. Lata joins in with more on that. Lata, the street believes that things are fundamentally looking very good.
Well, Credit Suisse believes that it is a 6 to 15% earnings growth. That is their upgrade. And I'm saying Credit Suisse because the Credit Suisse financial sector expert, Ashish Gupta, is about the best in breed. Widely consulted by government and RBI. So it's very important that Ashish Gupta has given an upgrade of 6 to 15% for all the EPSs of the top banks. SBI gets the biggest upgrade, 15%, ICICI 13%, IndusInd and Bank of Baroda, would you believe that, 12% higher, and Kotak and Axis get a 6% upgrade. HDFC Bank gets a 3% upgrade. They say that this is, the Ashish Gupta report says this is EPS upgrade is on a mix of higher net interest margins as well as lower credit cost. Now, first, the net interest margin yields on all the loans are increasing because these loans are linked to external benchmarks like repo or T-bill. So, external benchmark linked loans are giving banks some 140 to 190 basis point increase in interest rates. And most of the loans they have given have also been retail. Before I come to the retail loans, in terms of deposit, the costs have not gone much. The retail deposits, which are maximum one-year deposits, they have gone up by only 40 basis points compared to the increase in the loan rates. Only the bulk deposit rates have gone up and they don't constitute a very big share for banks. Coming back to loan growth itself is strong at 15%. It's led largely by retail and SME. Within retail, it's unsecured. Now, what does all this mean? All these are high-yielding loans, unsecured loans. The 30% of the retail loans are constituted by unsecured loans. As well, coming to credit costs, Gupta's report notes that private bank credit costs are lower by 50 to 70 basis points, even compared to the normal levels. Forget the last few years when, they were reeling under asset quality pressures. This is because corporate deleveraging has been very high and, the formula used, interest cover, whether it covers, EBITDA covers interest. The number of companies where EBITDA does not cover interest is at a historical low, which means corporate balance sheets have become robust, and that's why Credit Suisse has cut credit costs for banks by 5 to 20 basis points. The report ends with a very interesting addendum. Adani Group's debt alone has risen double. It has risen 2x in the last 2 years. In FY20, their total leverage was 1.36 lakh crore. In FY22, it is 2.6 lakh crore. But Indian Bank's exposure to Adani Group has not changed at all in the last 2 years. So a very, very interesting detail coming in.
Okay, Lata, thanks a lot for that. Well, let's do one thing. Let's wrap up with this edition of Halftime Report. Thanks a lot for watching. Business Lunch will take all the action ahead.